I'm 94 years old. I've been investing for over 70 years. And if there's one thing I've learned in all that time, it's that age matters in investing. Not because older people are less capable, not because you lose your edge as you get older, but because your time horizon changes. Your needs change. Your ability to recover from mistakes changes. And most importantly, the amount of risk you can afford to take changes dramatically. When you're 65 or 70 or 75, you don't have 30 years to wait for a portfolio to recover from a crash. You might have 10 years. You might have 20 if you're fortunate. But you definitely don't have the luxury of riding out a decade-long bear market and coming out the other side with time to spare. This is why I need to talk to you today about something urgent. If you're over 65 and you have significant money in technology stocks, you need to move it. Not eventually, not when the market gives you a better exit, but now, today, this week, because we're watching the beginning of what could be a brutal correction in the tech sector. The Magnificent Seven stocks have already started cracking. NVIDIA is down despite strong earnings. The Nasdaq has lost $1.74 trillion in value. Artificial intelligence stocks are getting hammered. And if you're sitting on big gains in Apple or Microsoft or NVIDIA or Tesla, thinking you'll sell when they recover to new highs, you might be making the biggest mistake of your retirement. Let me be very direct about this. Tech stocks are wonderful businesses. I own Apple. Berkshire's largest holding is Apple. These companies generate enormous cash flows. They have dominant market positions. They're incredibly well managed, but that doesn't mean they're appropriate for someone over 65. And it especially doesn't mean they're appropriate at current valuations after the run they've had. A stock can be a great company and a terrible investment if you pay too much. And right now, after tech stocks have dominated for over a decade, after they've reached valuations that only make sense if everything goes perfectly, they're dangerous for retirees. Here's what most people don't understand about risk when you're over 65. It's not just about volatility. It's about sequence of returns. It's about the order in which you experience gains and losses. If you're 30 years old and tech stocks fall 50%, that's actually good for you. You're adding money every month through your salary. You're buying more shares at lower prices. When the recovery comes, you'll be wealthier than if the crash never happened. But if you're 67 and retired and living off your portfolio, a 50% crash is catastrophic. You're selling shares to fund living expenses. You're selling at depressed prices. And when the recovery comes, you own fewer shares, so you benefit less. The same crash that helps a young person destroys a retiree. This is why I'm telling everyone over 65 to move money out of tech stocks now. Not because I think tech is going to zero, not because these are bad companies, but because the risk reward at current valuations for someone with a short time horizon is terrible. You're taking enormous downside risk for modest upside potential. And if you're wrong, if we get a real tech crash like we had in 2000 to 2002 when the Nasdaq fell 78%, you don't have time to recover. Your retirement is ruined. Let me tell you a story that illustrates exactly what I'm talking about. In the late 1990s, I knew a man named George. He was 63 years old, planning to retire at 65. He had built a nice nest egg of about $800,000. It was mostly in conservative investments, bonds, dividend-paying stocks, some utilities. Then he started hearing about the internet boom. Everyone was getting rich in tech stocks. His neighbors were making fortunes. His golf buddies were bragging about their returns. And George felt like he was missing out. So in 1999, at age 64, 1 year before his planned retirement, George moved most of his portfolio into tech stocks. He bought Cisco and Intel and Oracle and a bunch of dot-com companies whose names I can't even remember now. For about a year, he looked like a genius. His portfolio went from $800,000 to over $1.2 million. He was thrilled. He felt vindicated. He told everyone who would listen about his brilliant decision to embrace the future. Then March of 2000 hit. The Nasdaq peaked and started falling. By the end of 2000, George's portfolio was back down to $800,000. He told himself it was just a correction, that tech stocks would recover, that he just needed to be patient. By the end of 2001, his portfolio was worth $400,000. By 2002, It was worth 300,000. He had lost 75% of his peak value and 63% of his original 800,000. And remember, he was now 67 years old and retired. He needed that money to live on. George ended up having to go back to work. He couldn't afford to retire. His dream of traveling with his wife got postponed indefinitely. He spent the next 5 years working a job he didn't enjoy, trying to rebuild what he'd lost. And even though the market eventually recovered, George never did, because he'd been forced to sell shares at low prices to cover living expenses during those years. By the time the recovery came, he didn't have enough shares left to benefit from it. This story haunts me because I watched it happen, and I'm seeing the same pattern repeat today. I'm watching people in their 60s and 70s with huge positions in tech stocks after this incredible run. They feel wealthy, they feel smart, but they're one crash away from becoming another George. And I don't want that to happen to you. So let me tell you exactly where you should move your money. There are 3 places that make sense for retirees in this environment. 3 places that provide income, preserve capital, and let you sleep at night. 3 places that won't make you rich, but will make sure you don't go broke. And going broke is the only thing that matters when you're over 65. Building wealth is for young people. Preserving wealth is for retirees. And these 3 places preserve wealth better than anything else available right now. The first place is utility stocks. Boring, stable, regulated utility companies that generate electricity and natural gas and water. Companies like Duke Energy and Southern Company and NextEra Energy and Dominion Energy. These are not exciting businesses. They're not going to double in a year. They're not developing revolutionary artificial intelligence or disrupting industries. They're just providing essential services that people need no matter what the economy does. And they're paying dividends of 3.5 to 4.5% while they do it.
Here's why utility stocks are perfect for retirees. First, the dividends. Most quality utilities pay dividends in that 3.5 to 4.5% range. Some pay more.
That's real income you can spend. Unlike tech stocks that pay tiny dividends or no dividends, utilities send you cash every quarter. If you own $1 million of utility stocks yielding 4%, that's $40,000 per year in dividend income. You can live on that. You can supplement Social Security with that. You can pay your bills without selling shares. This income component is crucial for retirees. When you're working, you don't need income from your portfolio because you have salary income. But when you retire, you need your portfolio to replace that salary. Tech stocks don't do this. Apple yields 0.5%. Microsoft yields maybe 0.75%. NVIDIA pays essentially nothing. You can't live on that. You're forced to sell shares to generate income. And if you're selling shares during a bear market, you're destroying your future wealth. Utility dividends solve this problem. Second, utilities are stable. The earnings don't fluctuate much. People need electricity, whether the economy is booming or in recession. They need natural gas to heat their homes. They need water. These are non-discretionary services. And because utilities are regulated monopolies in most cases, they have predictable revenues and earnings. This stability means the stock prices are much less volatile than tech stocks. Utilities might fall 20% in a bad market. Tech stocks might fall 50%. That difference is enormous when you're living off your portfolio. Let me explain how utility regulation works because it's important to understand why these stocks are so stable. Utility companies operate under regulatory frameworks in each state where they do business. These regulators determine how much the utility can charge customers. The way it works is the utility calculates its costs, everything from fuel to maintenance to employee salaries to capital investments. Then the regulator allows them to charge rates that cover those costs plus a reasonable return on equity, usually around 9 to 11%. This means utility profits are essentially guaranteed by the regulatory framework. As long as they operate efficiently and make prudent investments, they earn their allowed return. They can't earn excessive profits because the regulators won't allow rate increases. But they also can't lose money because the regulators have to allow rates that cover costs plus the allowed return. This regulatory compact creates incredible stability. You don't see utility earnings swing wildly from year to year. They're predictable within a narrow range. Compare that to tech companies. Their earnings depend on product cycles, competitive dynamics, technological disruption, consumer preferences, global economic conditions, and a million other variables. Microsoft's earnings could fall 30% next year if cloud computing growth slows, or if AI spending disappoints, or if a competitor emerges with a better product. That's not going to happen to Duke Energy. Their earnings next year will be very close to their earnings this year, maybe up 5% if they've made capital investments that increase their rate base. Maybe down 2% if weather was unusually mild and electricity usage was lower. But the range of outcomes is narrow and predictable. Third, utilities are defensive. When the market gets nervous, when tech stocks are crashing, when growth stocks are getting hammered, utilities hold up relatively well. Not perfectly, they'll still fall, but they fall less and they recover faster. This defensive characteristic is exactly what you want when you're over 65. You need assets that don't fall as much as the market, that provide ballast, that let you sleep at night knowing your retirement isn't at risk. Let me give you specific examples of the kinds of utilities I'm talking about. Duke Energy operates electric utilities in the Carolinas, Florida, Indiana, and Ohio. They serve 8 million customers. They generate mostly from natural gas, nuclear, and increasingly renewable energy. They pay a dividend around 4%. The stock is boring, it trades in a narrow range. But it's safe. The earnings are predictable, the dividend is sustainable, and you can count on that 4% income year after year. I like Duke Energy particularly because of their geographic diversity. They're not dependent on one state's economy or one state's regulatory environment. They operate across multiple states with generally supportive regulators. They've been paying dividends continuously since 1926. That's almost 100 years of uninterrupted dividends. Through the Great Depression, World War II, multiple recessions, every crisis you can imagine. The dividend kept coming. That's the kind of track record you want when you're over 65. Southern Company is similar. They operate in Georgia, Alabama, Mississippi, and other southeastern states. 4.5 million customers, mostly natural gas and nuclear generation. Dividend around 3.8%. The company grows slowly but steadily. The dividend increases gradually every year. And the stock provides exactly what a retiree needs: income and stability. What I particularly like about Southern Company is their nuclear exposure. They operate multiple nuclear plants, and they're building new nuclear capacity at Plant Vogtle in Georgia. Nuclear power is expensive to build, but very cheap to operate once it's running. And it provides baseload power that's reliable and carbon-free. As the country moves toward cleaner energy, Southern Company's nuclear fleet becomes more valuable. This gives them a growth element that most utilities lack. The dividend might grow 4 or 5% per year instead of 2 or 3%. Over 20 years, that compounds into significantly more income. NextEra Energy is slightly different. They're the largest utility in Florida, but they also own NextEra Energy Resources, which is the world's largest generator of renewable energy from wind and solar. This gives them a growth component that most utilities lack. The stock is more volatile than traditional utilities, but still far less volatile than tech stocks. And they pay a dividend around 2.5% that grows faster than most utilities. For retirees who want some growth potential with their stability, NextEra is a good option. The renewable energy business is particularly interesting. NextEra Energy Resources builds wind and solar farms and then signs long-term contracts to sell the power to utilities, corporations. These contracts are typically 15 to 25 years. The revenue is predictable. The costs are mostly upfront capital to build the projects. Once they're operating, the fuel is free because wind and solar don't require fuel. This creates very stable cash flows that support dividend growth. And as more companies commit to carbon neutrality, demand for renewable energy keeps growing. NextEra is positioned perfectly to benefit from this trend. Dominion Energy is another quality utility worth considering. They operate in Virginia, North Carolina, South Carolina, and other mid-Atlantic states. They generate mostly from natural gas and nuclear. They also have a large natural gas transmission and distribution business. The dividend yield's around 4.2%. The company is well managed and has a strong balance sheet. They're making significant investments in offshore wind, which will drive growth over the next decade. For retirees, Dominion offers a high current yield plus modest growth potential. American Electric Power is my last utility recommendation. They're one of the largest electric utilities in the country, serving 5 million customers across 11 states. They operate primarily in the industrial Midwest and South. Dividend around 3.8%. What I like about AEP is their exposure to industrial customers. As manufacturing returns to America, as companies reshore production, the industrial heartland will benefit. AEP is positioned to grow as this trend develops, and they pay a solid dividend while you wait for that growth to materialize. Now, let me address the objections. I always hear about utility stocks. People say they're boring. They say the returns are mediocre. They say you'll never get rich owning utilities. And all of that is true. But you're 65 or older. You're not trying to get rich. You're trying to not get poor. You're trying to preserve capital and generate income and sleep at night. Utility stocks do all of that. Tech stocks do none of that. Tech stocks are for wealth accumulation. You're past that phase. You're in the wealth preservation phase. And utilities are perfect for wealth preservation. People also say that utilities are sensitive to interest rates. When rates rise, utility stocks fall because the dividend yields become less attractive relative to bonds. This is true. But here's what matters. The Federal Reserve is probably done raising rates. They might cut rates in December. They might cut more next year. The direction for rates is sideways to down, not up. This is a favorable environment for utilities. And even if rates rise, the impact on utility stocks is modest compared to what can happen to tech stocks when sentiment shifts. I've seen this dynamic play out many times. In the early 2000s, when the dot-com bubble burst, utilities held up well while tech stocks crashed. In 2008, when the financial crisis hit, utilities fell less than the overall market and recovered faster. In 2020, during the COVID crash, utilities fell about 25%, while tech stocks fell 35 to 40% initially before their massive rally. The pattern is consistent. Utilities provide downside protection in crashes, and when you're over 65, downside protection is more valuable than upside potential. The second place to move your money is consumer staple stocks. These are companies that make products people buy regardless of economic conditions. Food, beverages, household products, personal care items. Companies like Procter & Gamble, Coca-Cola, PepsiCo, Colgate-Palmolive, Johnson & Johnson, Walmart, Costco. These businesses have been around for decades or centuries. They've survived every economic crisis imaginable, and they'll be here long after the current tech darlings have faded. Consumer staples have similar characteristics to utilities, but with some important differences. They pay solid dividends, usually in the 2.5 to 3.5% range. Not quite as high as utilities, but still meaningful. They have stable earnings because people keep buying toothpaste and soap and food, even in recessions. They have pricing power because their brands are so strong that customers will pay up rather than switch to generic alternatives. And they grow modestly but steadily as populations grow and living standards rise globally. Let me walk through why consumer staples make sense for retirees. Start with Procter & Gamble. This company makes Tide detergent, Crest toothpaste, Pampers diapers, Gillette razors, and hundreds of other household products. You probably have a dozen P&G products in your home right now. The company has been around for 187 years. It survived 2 world wars, the Great Depression, multiple recessions, and every crisis in between. It pays a dividend around 2.4%, and it has increased that dividend for 67 consecutive years. 67 years. Through everything that's happened, every crisis, every recession, P&G has raised its dividend every single year. This dividend growth record is remarkable. Think about what 67 consecutive years of dividend increases means. It means the dividend grew during the stagflation of the 1970s, during the recession of the early 1980s, when unemployment hit 10%, during the stock market crash of 1987, during the Gulf War, recession of the early 90s, during the dot-com crash, during 9/11, during the financial crisis when the banking system nearly collapsed, during COVID. Through everything, the dividend kept growing. That's the definition of reliability. That's what you want to own when you're over 65. So the reason P&G can do this is their business model. They sell products people use every day. You're not going to stop brushing your teeth because the economy is weak. You're not going to stop washing your clothes. You're not going to stop changing your baby's diapers. These are necessities. And P&G's brands are so strong that people keep buying Tide even when generic detergent is cheaper. They keep buying Crest even when store brand toothpaste is half the price. This brand loyalty creates pricing power. When costs go up, P&G raises prices. Consumers grumble, but they pay. This pricing power protects margins and supports consistent earnings growth. Coca-Cola is another perfect example. The company sells beverages. That's it. No artificial intelligence, no cloud computing, no disruption, just selling Coke and Sprite and Fanta to people all over the world. They do it profitably, they do it consistently, and they pay a dividend around 3% that grows every year. The stock is stable. The business is predictable, and you can count on that dividend income to help fund your retirement. I've owned Coca-Cola in Berkshire's portfolio for decades. I've watched the company navigate every challenge imaginable: new competitors, changing consumer preferences, health concerns about sugar, currency fluctuations in international markets, regulatory challenges in dozens of countries. And through it all, Coca-Cola keeps selling beverages and making money. The business model is so simple and so powerful that it's almost impossible to mess up. You make a product people love, you distribute it everywhere, you market it constantly, and you collect profits. It's not complicated, but it works. And it's worked for 139 years. The international growth story for Coca-Cola is particularly compelling. As emerging markets develop, as incomes rise in Asia and Africa and Latin America, beverage consumption increases. People want branded products. They want Coca-Cola. The company's already there in these markets. They have the distribution. They have the brands. They just need to grow with the population and rising incomes. This provides a growth tailwind that will last for decades. So you get a stable dividend plus modest growth. Perfect for retirees. PepsiCo is similar, but with more diversity. They have beverages like Pepsi and Mountain Dew and Gatorade. But they also have snacks through Frito-Lay, Doritos, Cheetos, Lay's chips. People eat these products constantly. The business is incredibly stable. The dividend is around 2.7%, and the company has raised its dividend for 51 consecutive years. This is wealth preservation at its finest. What I particularly like about PepsiCo is the snack business. Beverages are great, but they're facing headwinds from health concerns about sugar. Snacks are also facing some of those concerns, but to a lesser degree. And more importantly, the margins in snacks are excellent. When you buy a bag of Doritos, most of what you're paying is profit. The actual cost of the corn and seasoning is minimal. The value is in the brand and the taste and the convenience. This margin structure means PepsiCo can raise prices to offset inflation and still grow earnings. That supports steady dividend growth. And dividend growth is what retirees need to maintain purchasing power over time. Johnson & Johnson is technically a healthcare stock, but it has consumer staples characteristics.
They make Band-Aids and Tylenol and baby products. They also have pharmaceutical and medical device businesses. The company has increased its dividend for 61 consecutive years. They yield about 3%.
And the business is as stable as they come because healthcare spending is non-discretionary and growing as populations age. The pharmaceutical business gives Johnson & Johnson an element that pure consumer staples don't have: drug patents. When they develop a successful drug, they have patent protection for years. This creates very high margin revenue. When the patents expire, generic competition comes in and margins fall. But by then, they've usually developed new drugs to replace the revenue. This constant innovation cycle supports earnings growth. Combined with the stable consumer products business, you get a very attractive risk-reward profile. Stability plus growth, income plus capital appreciation, perfect for retirees.
Colgate-Palmolive is another high-quality staple worth considering. They make toothpaste, soap, pet food, and other personal care products. The dividend yields around 2.3%.
They've increased it for 60 consecutive years. The business is extremely stable. Everyone brushes their teeth. Everyone washes their hands. These are daily habits that don't change based on economic conditions. And Colgate has leading brands in most of their categories. This market position supports pricing power and margin stability. The international exposure is significant for Colgate. About 75% of their revenue comes from outside the United States. This means they benefit from
growth in emerging markets where oral care and personal care habits are still developing. As these markets mature, as people adopt Western hygiene practices, Colgate's products become essential.
The company's been building distribution in these markets for decades. Now they're harvesting the rewards for retirees. This provides a growth element without the volatility of pure growth stocks. Walmart and Costco are retailers, but they have staples characteristics because they sell necessities. People need food and basic household items. Walmart and Costco provide those at low prices. The business models are proven. The companies generate enormous cash flows. Walmart yields 1.3%. Costco yields 0.5%. Not as high as other staples, but still meaningful. And both companies have track records of steady growth and capital appreciation that complements the dividend income. Walmart is particularly interesting right now. They're investing heavily in e-commerce and competing effectively with Amazon in grocery delivery and online general merchandise. These investments are expensive and weighing on near-term margins. But they're building a business that will be very valuable long-term. Once the infrastructure is in place, the incremental cost of each transaction is low and margins will expand. For retirees with a 10 or 15-year time horizon, Walmart offers value and growth potential. Plus, the dividend, while low, has been increased for 51 consecutive years. The company is committed to returning cash to shareholders. Costco is a different story. The dividend yield is low because the stock trades at a premium valuation. People love Costco. The business model is brilliant. They charge membership fees that provide guaranteed revenue. Then they sell merchandise at razor-thin margins. The membership fees are basically pure profit. This allows them to offer unbeatable prices on quality merchandise. Customers love it. They renew their memberships at 90% rates. And the business generates massive cash flow that funds expansion and share buybacks and modest dividend growth. For retirees, Costco provides stability and growth. The yield is low, but the total return over time should be solid. Now let me address why consumer staples are better than tech stocks for retirees. The key is resilience. In the 2000 to 2002 crash, the NASDAQ fell 78%. Consumer staples fell about 15%. In the 2008 financial crisis, the S&P 500 fell 57%. Consumer staples fell about 30%. In every crash, staples fall less. They provide downside protection, and when you're over 65, downside protection is more important than upside potential. I remember 2008 vividly. The financial system was collapsing, banks were failing, credit markets were frozen, stock portfolios were getting destroyed, people's retirement plans were in ruins. But consumer staples held up relatively well. People kept buying Tide and Crest and Coca-Cola and groceries from Walmart. These companies kept making money. They kept paying dividends. And their stock prices, while down, weren't devastated like the overall market. Retirees who had significant allocations to staples survived that crisis much better than those who were heavily in financials or tech or cyclical stocks. The other advantage is that staples give you income plus modest growth. The dividends provide cash you can spend, but the stocks also appreciate slowly over time as the companies grow earnings and raise dividends. Over 10 years, you might make 6 or 7 or 8% per year from a diversified basket of consumer staples. That includes the dividend plus modest capital appreciation. It's not going to make you rich, but it's going to preserve your purchasing power and provide income. That's exactly what you need. People object to consumer staples by saying they're mature businesses with low growth. That innovation is happening elsewhere, that you're missing out on the future by owning these dinosaurs. And again, all of that might be true, but you're over 65. You're not trying to capture the future. You're trying to fund your present and preserve capital for however long you live. Consumer staples do that better than anything else except maybe utilities. The third place to move your money is investment-grade corporate bonds. Specifically, short to intermediate term bonds from high-quality companies, bonds with maturities of 3 to 7 years, issued by companies with strong balance sheets and predictable cash flows. These bonds currently yield 5 to 6%. That's real income. And unlike stocks, the income is contractual. The company is legally obligated to pay you that interest. And at maturity, they're legally obligated to pay back your principal. Bonds are the forgotten asset class. Everyone focuses on stocks because stocks have higher